Good day for you, tax traders, and welcome to this weekly preparation for the week ahead. Very briefly, what we're going to take a look at is just some of the key important things to consider when prepping for a week, and how I would go about, obviously, preparing for my week ahead. So first thing we're going to take a look at is the weekly calendar, and as you'll see, what I've done is I've kind of almost highlighted and starred the key risk events for the week. Now, what a key risk event is, well, it's anything that the market is particularly sensitive to with regards to certain data pieces. Now, if we go over this very briefly, you'll see over Monday today, we haven't really got any significant data. Of course, housing data is important, but for the macro markets, existing home sales is not as important, and so it's not a key risk event. And in terms of the risk allocation, I'm only going to allocate pretty much 20% of my trading day to Monday. Going forward then on Tuesday, obviously, we've got a lot more important data. We've got the German IFO data, as well as the UK CPI, which is quite possibly the most important risk event for the week, and particularly for the UK markets. Now, the reason CPI is particularly important is because the markets have become very sensitive now to inflation, given the backdrop of what central banks are doing and how they're trying to almost create inflation and get rid of this idea that there's deflation in the market. So that's a particularly important number to watch out for. And also, just as I've noted below here, UK CPI, possible upside risk as the oil base effects start falling out. So important. Know that, guys. As the oil price is rising now, and as we've obviously seen over the course of last year, we had very low oil prices. That impact is going to start falling out of the calculation methodology that they use for the CPI. So don't be surprised if we do start to get sort of upside beats. And the reason I've sort of thought about that is because of what we saw, particularly now for the last 2 months in particularly the US CPI calculation. So we are starting to see upside numbers that are sort of beating to the upside against the expectations. So just keep that in the back of your mind. Then going forward, we've obviously also got the German ZU as well as the US Richmond Fed. So again, one risk event for the day, but a little bit more risk allocated as we do have a bit more data out. Going forward to Wednesday, again, we have further US housing data in the new home sales, and then the all-important oil inventories. Now again, if you go back sort of a year or two ago, oil inventories was not an important number. Of course, it moved the oil, but it didn't move global markets. And at the moment, obviously, because the market is very sensitive to commodities, to the slowdown and to inflationary pressures, oil inventories is very closely watched every week, and it does drive market sentiment. So keep an eye on that over the course of Wednesday. Again, we allocate 25% risk. Then on Thursday, we've got the French and German PMIs, the first reading for this month. Again, note this is post the PMI, post the ECB that we had 2 weeks ago. And obviously, just keep in mind, obviously, the European manufacturing sector is probably one of the better manufacturing sectors at the moment, and Draghi's obviously alluded to that recovery quite a number of times. We then have the UK retail sales at 9:30. Again, note we do have a UK, or the recovery in the UK is being led by the consumer. So again, it's a more sensitive number, and the market will react a little bit more to the retail sales on Thursday. And then we have the US durable goods in the afternoon, and that's again another 25% allocation. Friday, obviously, it's Good Friday, it's the Easter long weekend, and as you'll see as I scroll down here, what I'm going to talk about here, guys, is 2 things. One, it is the Easter break period. Note, all your hedge funds, all your big fund managers will be taking a very short week this week. They will only have sort of, the kind of staff that'll be sitting there to execute stop orders if certain levels are reached. So just keep that in the back of your mind. The opportunities and the flows are going to start disappearing very quickly on already Thursday afternoon, as most people will take Thursday to the following Tuesday off. And then also just the importance, guys, it's so important as day traders is to take an opportunity when the markets are quiet and when there's a lack of flow in the market. It's important to take time off and just switch off and get away from the markets and refresh yourself, because there will always be better opportunities in the days and months ahead that you can take advantage of. So just make sure you understand that. Then another just thing to point out, obviously, we have just had the roll now in the bonds, the FX, the oil, and the equity. So everything is rolled. Why that's important? Well, very simply, guys. Remember, when the futures roll, our levels tend to, sort of not necessarily disappear, but everything changes. So the charts start to look different. The structures look different. So just keep that in the back of your mind. When we've just finished roll, you almost want to allow the market to re-establish itself, re-establish some points of interest, some support and resistance, and then start to trade off. So don't be too aggressive heading out this week into the markets. Let some structure form, and then get involved. Then we move on to our global macro themes, and it's so important. A lot of traders tend to almost forget about these things, and the reason I highlight them is because sentiment in markets can shift very, very quickly. Now, four of the key sort of themes at the moment in the market are: one, obviously, there's been a lot of talk about oil and the OPEC meeting. We've heard about the proposed freeze, and there is a proposed meeting coming for OPEC members. So just keep that in the back of your mind. The market will obviously start to, or the oil will most likely rally into that meeting as the market sort of almost will price in a favorable outcome of that meeting. So just keep that in the back of your mind. Then obviously we had the dovish Fed last week, and we will talk about the Fed very briefly in a minute. And then obviously the bazooka ECB. Keep that in the back of your mind. The ECB deployed and over. Gave the market a lot more than expected. So just keep that in the back of your mind. We are seeing central banks sort of very aggressive in their policy at the moment. We also have the UK Brexit concern. Don't forget, Boris Johnson, not even a month ago, came out and he's voting for the No campaign, and we saw cable, dump all the way down to sort of 138.5. So don't forget these things. The Brexit, concerns and the risk of a Brexit is still very much there, at some point we will start to see those pressures come back into the cable market and the gilt markets. And then obviously the China slowdown, guys. A slowdown doesn't stop overnight. Just because China is cutting rates and doing all sorts of stimulus measures, it doesn't mean that the slowdown is not there. Of course it's there. We're still seeing commodity prices at yearly lows. We still have concerns of deflation, and we still have relatively slow earnings coming out of most of the major companies at the moment around the world. So just keep that back in your mind. These themes don't disappear. These themes will most likely be here for the entire 2016. So just keep that in the back of your mind, and obviously understand, what will the implications be if, for instance, we had a key Chinese data piece come out tomorrow and it was worse than expected. How will the sentiment shift? How will the market move based on these global macro themes? So just keep that in the back of your mind. Then just to summarize last week, again, very important, the reason we do this is so that we can sort of try and pick up on any kind of correlations that might be, sort of starting to form. And if you do this on a week-to-week basis, not only are you going to keep up to date with sort of which markets are outperforming, but you're also going to start to be able to build a global macro type correlation theme. And as you can see over the course of last week, so the US 10 years, they sold off 10 basis points. Obviously that was, sort of the Fed's doing. They were flat, if not higher, going into the Fed meeting, and then reversed all of that after the Fed meeting. The Bunds lagged, but also down 7 basis on the week. Moving forward, the equity indices, as we can see, clear outperformance by the US equity markets. Now again, that is attributed to the Fed, because we saw very, very much going into that meeting that all three equity indices were mostly, sort of flat in line together pre-FOMC. Post that, obviously, we've seen the Euro stocks down 0.8 on the week, the E-mini S&Ps up 1.5, and the DAX mostly flat on the week. In terms of the oil and the gold, we can see oil was up 1.5 or $1.30 on the week, and that is the 5th green week in a row. So again, we can see a strong trend developing in the oil at the moment, as well as gold was up $4 on the week. In terms of our emerging markets, well, we can see that they're still relatively stable. We're actually seeing most of the emerging market currencies, rally nicely against the dollar, and they did particularly well post the Fed. We saw some very strong gains for emerging market currencies after the dovish Fed. So just keep that in the back of your mind. The Chinese yuan on the week, obviously a very key important, currency at the moment for, gauging how, what China is doing and how they're managing their FX. And obviously, again, we saw a very strong, rally in the Chinese yuan against the dollar last week. So again, this is the 3rd week in a row we've actually seen, the yuan rallying against the dollar. Moving forward, the dollar index dropped 1.3%, and again, third big week down in a row. We're starting to see a little bit of an unwind in dollar positions, and that's no surprise, obviously, given the dovish FOMC. And then our inflation expectations, and I will show you a chart of this in a minute, but effectively we're starting to see some very aggressive, inflationary pressures starting to build in particularly the inflation expectations, not so much the bonds. And then obviously we also have European inflation expectations continuing to fall. So we're starting to see this divergence between inflation expectations in the US and Europe. And as a result, you're going to start to see some spread plays obviously coming back into favor. So our key highlights for the week, obviously we had the dovish Fed. I'm just going to very quickly go through this. Our dots, we're only going to hike twice this year according to the Fed dots. Global developments continue to pose a risk. Inflation compensations remain low, and the Fed was surprised that wage growth had not picked up, and they indicated that was possibly a result of there being more slack than initially anticipated. They also spoke about reinvesting, continuing to reinvest their proceeds from maturing bonds until normalization was well underway, and obviously they kept their medium-term inflation target at 2%. So that was the key highlights. Obviously the market was expecting a little bit more of a hawkish Fed, but the important takeaway from that is how is the market pricing looking for, going forward now after the before and after the FOMC. And the important standout point with these two sort of blocks is that initially you can see that that the market was sort of thinking about 1.5 hikes as of the end of this year. Note, however, post the FOMC, the market's now only thinking one full hike this year. So just bear in mind the Fed told us that, one, obviously they're planning on hiking twice this year, or their expectation is for 2 hikes, but 2, also they're happy to allow for some form of an overshoot in inflation. So just keep that in the back of your mind, because as you can see, the market's pricing, based on what the Fed is saying, is still more dovish than the Fed. So keep that in the back of your mind. Obviously, if we do start to see inflationary pressures rise, we may then finally see these markets correct and actually start pricing or reflecting more the view of the Fed instead of being sort of where they are at the moment and only pricing in 1 hike for 2016. So let's have a quick look at our inflation expectations then. As you can see, this is a grid of our 5-year inflation expectations out of the US. And we started the year off, to put things into perspective, we actually started the year off around 1.78% in the 5-year forward inflation expectations. As of Friday, we can see we're not that far off in terms of these inflation expectations, and we've bounced quite aggressively from the lows formed in February. So that's the US inflation expectations. As for the European inflation expectations, we see something very, very different. We obviously got the similar bounce to the US, but ever since the ECB, and this red line here reflects the ECB day, ever since the ECB day, we've actually started to see inflation expectations dip again. So very important, guys, make sure you understand this. But the whole reason why Mario Draghi pulled the bazooka out and really fired all his bullets was to get these inflation expectations to start rising. And in essence, he's not getting the desired effect. The euro is stronger as of the meeting. I think we're about 400 pips higher. Inflation expectations are dropping. Yes, equities are higher. Yes, bonds are higher. But their policy is not quite getting the desired effect, and that is going to cause some, sort of down the line, some sort of a trade opportunity for us. So have a think about that, and make sure you do understand, the potential for what's to come. Then looking forward onto the week, obviously some trade opportunities are so important, guys. When you look at your charts on a weekly basis, make sure you highlight for yourself, where are those key opportunities? Where are those almost, those holy grail plays coming from? Those, where the confluence, everything sets up together, the fundamentals, the technicals, the short term, the price action, everything comes together, because it's those opportunities that are going to give you your bread and butter. And at the moment, some of the trade opportunities I'm looking for is, obviously, late last week we saw a very strong move in the yen as it attempted to break out of a flag type structure, and the result was it had a very close correlation, or at least a negative correlation, with both the E-minis and the stocks, and a positive correlation with the euro dollar. So I'm looking very closely at that this week. If we do start to see some yen flows, I will be initiating some very aggressive plays in those 3 markets. In terms of the curve play, obviously, we, as a result of those diverging inflation expectations between Germany and the US, I will be looking to obviously be a buyer of bunds versus a seller in the US 10-year. And again, I'm not trying to do anything smart. All I'm doing is merely playing one with the trend, but also two, playing the fundamentals. And we can see fundamentally that inflation expectations are diverging, and as a result, we should start to see the yield between US 10-year and German 10-year spread. In terms of obviously, as Alex Hayward mentioned, some very aggressive steepener opportunities as a result of the Fed meeting and sort of their sort of not hawkish stance, but their allowance for potential higher inflation. That should start to create some pretty aggressive steepening, in the back end versus the front end. So just keep an eye on those 210s, 230s. There could be some fantastic trade opportunities this week. And then we finish off with our charts that matter. These are key charts that are sort of posing some interest to us. And the reason we've got the VIX up first is because, at the moment what we've seen is I think we're in the 7th week in a row now of solid gains in the US equity markets, and particularly the E-mini S&Ps. We've seen seven green candles in a row now, all the way from the 1880 levels all the way up to 2040. So right now we're obviously seeing this rally, and we're seeing sort of the VIX, the volatility index, at the lowest levels in the year. So again, probably reflecting almost a lack of sentiment, a lack of sort of anything really going on in the markets, and obviously a lack of fear. We then move to the minis. As we can see, we've got weekly one-time framing. However, note we are getting some very aggressive volume and momentum divergence. In other words, yes, this trend is very firmly intact, but the important thing to understand is we're going up on lower and lower volume, and the momentum does seem to be stalling. So, Friday's candle, we obviously had a very tight distribution type day, with a lack of interest on either side to trade. So just keep an eye on this. Once it does turn, note, obviously, when you do get these divergences, they do tend to turn quite easily, and you don't get much support as the market turns back around. So just keep an eye on the E-mini S&Ps. And we move on to our China yuan. The reason, obviously, we're starting to see some nice aggressive appreciation in the yuan. Obviously, this is very favorable for the the Chinese PBOC. However, note we are seeing this on a backdrop of a weaker dollar. So just keep that in the back of your mind. It's playing into the hands of the PBOC. However, we are also seeing a weaker dollar. So you've got to ask yourself, what would it have been like had we seen this in a stronger dollar environment? So just keep that in the back of your mind. But more important is that what we should be seeing on these stronger yuan fixings, you should actually be seeing this reflecting in particularly the Shanghai index. And that's why if we look at the Shanghai and the Chinese stock market, we can see whilst we are obviously higher over the last 3 weeks, it's very minimal, guys. I think we're barely up 2% over the last 3 weeks in the Chinese stock market versus almost a 7-8% rally in the US and maybe a 5% rally in Europe. So just bear that in the back of your mind. The stronger yuan fixing is not quite leading to stronger equity results in China. But more important, don't forget that it's been China that's led the sentiment all year. So keep an eye on the stock market. If we start to see this sort of unwind and offer down, sentiment can turn very, very quickly. And just keep that in the back of your mind. The Shanghai is definitely not reflecting the case that other global indices are reflecting. And then our last market of interest is the dollar index. Again, we've had 3 down weeks in a row in the dollar. More importantly, we have now closed below this swing low. It was the low, or it's the lowest level for 2016. So a little bit more of an important pivot. It does seem now that the Fed is sort of almost narrowed the divergence between where they're expecting rates to go and where the rest of the world's rates are going. That we could actually start to see maybe not an aggressive sell-off, but just further sort of profit taking in the dollar space. Bear in mind we're still very firmly in a bullish flag structure. However, it does seem as though the trend is firmly to the downside, and we should see further dollar unwind over the period of this week. So that's pretty much our important markets. What we then would typically finish off with, and it's something I'm happy to show you. I won't leave too much time on it, but just something to go and look at in your week is your areas, what your positives for your week were, and then obviously what some of your weekly goals were. So go over your week from last week. Have a look at those areas. Where could you have improved? where could you have done better. Make sure you're good to yourself also, and point out where did you trade well, how did you trade well, what did you do well, and then finish off by setting yourself some firm goals for the week. Realistic, attainable goals that you can then measure and benchmark yourself against. If you have any questions, obviously you can send me a message on Twitter. Otherwise, this is Brannigan signing off. Have a good day and good luck for the rest of the week.